Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. With the D-Day landing anniversary going on in the background, there was mixed news on the interest rate front this week, with the central bank in Canada and the European Central Bank, the ECB, becoming the first two G7 country central banks to announce cuts since the inflationary spike. But hopes that the Federal Reserve might be coming in behind were dented by the latest non-farm payrolls data that came out on Friday. This was stronger than expected and yet again shows that the American economy is still powering ahead, and therefore that is going to possibly put back the date when we see the first cuts from the Federal Reserve. Though that data was enough to cause a small spike in US Treasury yields, with the 10-year spiking up around 150 basis points. But that came after a week in which yields generally had been falling, including in the gilts market over here. In the equity markets, it was a positive week. A slight pause again at the end of the week after that US data came out, but essentially most leading equity markets were up over the course of the week, led by Nasdaq, up more than 2%, and followed by the S&P 500, and the European bourses and Japanese market perking up a little bit as well. FTSE Ava was not so strong, grinding out a small loss. In the investment trust sector, the index was up over the week by just over 1%, and the average discount narrowed very slightly, finishing on Thursday at least at 13.9%. Turning to individual trusts, there were a roughly an equal number of gainers and losers in the investment trust sector. Notable on the loser side, there was a bit of a sell-off in small cap trusts, which have been perking up recently. But on the positive side, there were gains for the battery storage trusts following an announcement by Gresham House Energy Storage, one of the three battery storage trusts, that it has struck a deal with Octopus Energy that will guarantee 50% of its revenues at a fixed price over the next 2 years. They were the strongest performers, but also there were good performances from the Indian Trust, shrugging off the surprising decline in Modi's support in the Indian general election, which had caused a little sell-off when the news came out, and good performances also by the tech trusts, Polar Capital and Manchester and London both hitting new all-time highs, and also by Pershing Square Holdings on the back of its plans to launch a second trust, this one listed in the US rather than the Pershing Square Holdings one we know over here listed in the UK. There were a handful of results, not many this week. We had 5 annual results. The pick of them would be the performance of the Biotech Growth Trust, ticker BIOG, which produced a very impressive 26.5% NAV total return. And also positive showings from Worldwide Healthcare, producing an NAV total return of 12%, and Templeton Emerging Markets, which has reported a 7.9% NAV total return for its latest 12-month period, and has also announced a series of measures designed to revive its somewhat flagging share price. For subscribers to the Moneymakers Circle, you will of course find our usual summary of all the latest news, a series of other interesting announcements as well this week. And our investment trust profile this week features Scottish Mortgage Trust, well known to most listeners. We take a look at this trust again, having last reviewed it back in 2021. Hope you'll enjoy that. I've also recorded a short video looking at the gilts market, seeing whether there's any signs that interest rate cuts are imminent. And also, I would urge you to look out for, we are going to be recording an election special on the 26th of June. Might be interesting to you. This time it will not involve any current political figures. We don't want any hot air or unfunded promises. Thank you very much. But we will be having a conversation about the likely outcome of the election and the consequences for investors, featuring 3 distinguished guests whose names I will be able to disclose next week. So that's something I hope you might tune in for. There's obviously a lot of election coverage out there, but we'll try and do something which is both firmly editorially independent and, I hope, insightful, in keeping with the mission that we try to achieve here at Moneymakers. So this week I had a chance to have a three-way conversation with two of the regular guests on the Moneymakers Investment Trust podcast, namely Nick Greenwood, the manager of MIGO Opportunities, what I would call the special situations investor in other investment trusts, and also Ben Conway, who is the head of fund management at Hawksmoor Fund Management, an independent wealth management firm. So obviously this week all the news has been dominated and will be for the next 3 or 4 weeks by the election in the UK. Arguably other elections around the world are more important than ours. But I just ask you first for a quick reaction to that. It seems like a foregone conclusion. The markets seem to have taken it in its stride. Would that be your assessment also, Nick?
I think so. I think that it's a bit of a non-event because I think we all know the result and therefore investors will have factored that into their calculations. So I think it's a bit of a non-story, I'm afraid.
We don't know, of course, what any new government will actually do as opposed to what they so far said they won't do. But there is going to be this backcloth then of whoever wins this election. It does look like Labour will win easily. They are going to be very constrained in what they can do because of the fiscal situation in this country.
Yeah, which is actually one of the reasons why I'm optimistic / I suppose maybe dangerously complacent about it. I completely agree with what Nick just said, but you can pick up some nice clues about the Labour government's intentions from a document called Financing Growth that they published some weeks ago, which basically says, to cut a long document short, we need to rely on capital markets to fulfil our ambitions to grow the economy. They realise the Treasury is very indebted. The only way that they're going to achieve their ambitions with regard to sectors like renewable energy or infrastructure is to rely on private capital. Rachel Reeves is always saying that the only way they can achieve their ambitions is to grow because they can't force more debt onto the economy. And the last thing, of course, is that they readily recognise that the UK equity market as a whole is undervalued. So I just cannot see them doing anything to put any additional barriers in the way of our capital markets. In fact, quite the opposite. So perversely, optimistic.
Okay, well, we'll see whether that survives contact with reality, but it's a promising start at least. And of course, I guess we've got to think that the gilt market is also going to be quite important because whatever government takes over, they've got to finance what they need, and there's quite a lot of refinancing of debt needed. Just on that point, I don't know where you, either of you, sit in terms of thinking about interest rate cuts and so on. The market's obviously been retreating from thinking about very early interest rate cuts. Have you got any more perspective on that?
It's interesting the last few days that certainly the Treasury market in the US, as the yields have been coming down quite nicely, which is quite important for a lot of the alternative issues that we have in the trust world, which are high-yielding products. If we do get a couple of cuts in interest rates, it would be incredibly positive for that area. And it does feel as though we will get a cut or two. And that's not a negative, but it's not as big a positive as we were hoping for in the last quarter of last year. But expectations have now moved to, in many cases, no cut. But I think actually, we probably will get a cut or two. So that's mildly positive, which is good for me, being the sort of perma bear.
Indeed. Well, we'll come back to your thoughts about that. But one obviously very pertinent issue to the investment trust sector, and I'm going to come to you, Ben, on this one, is this issue around cost disclosure. Obviously, there's been a big campaign of which you've been a prominent part, supported by many others, calling for changes to the regime, current cost disclosure regime that, in your view, and I think most people's view, unfairly penalises investment trusts compared to other types of investment fund. So what's the situation of that now? We haven't had any legislation that we were hoping for to implement that change. Got to wait till after the election, and there may well be other priorities, may there not?
Yeah, the sooner than expected calling of the election was frustrating in terms of the legislation that was in train. So Baroness Altman's private members bill went through 3 readings in the House of Lords, was about to go to the Commons, had full cross-party support in the Lords. And then, unfortunately, as with all outstanding private members' bill, they're nixed as soon as the election's called. So sadly, that avenue is now closed to us. We still have the statutory instrument withdrawing the UK from the PRIPS regime, which is going to become in this country the CCI regime, Consumer Composite Investment Regime. And there was the consultation that ended in January, if you remember. That was the one where LSE Group, London Stock Exchange Group, issued a joint response to the consultation, 329 signatures. We're waiting for a response from Treasury on that. And who knows what the Labour government will do with that statutory instrument. We'll have to wait and see. But obviously there's a delay in terms of the passage of that secondary legislation. But in the meantime, we're still pulling together very, very strong arguments that we're hopeful that one day the FCA will understand and listen to, which is that even under the existing legislative and regulatory framework, there is room for the FCA to issue, we think at least, guidance that investment companies simply do not have ongoing charges per the existing regulations. Now, this is the point we make about disclosing and not double counting. This is the idea that they have recurring operating expenses that impact the NAV, that are known in advance, i.e. you know these operating expenses are going to recur, for example, the management contract with the investment advisor, and they are discounted into the share price. So we're just making sure that our mantra, which is, as you know, is disclose, don't double count, we're just making sure that that message is put across, that we are not trying to hide anything. We're very, very pro-disclosure. We're very pro the publishing of these recurring operating expenses that is expressed as a percentage of NAV. That'll aid comparison with other open-ended funds and indeed within the sector. So we're still very, very pro that. And so we're engaging with as many stakeholders as we possibly can in the meantime. So shareholder organisations, for example. We're open-minded. I really encourage, if anybody thinks that we've missed something, if anybody thinks that there's something wrong with any of our arguments, we really would encourage them to get in touch with us when we're just trying to engage, particularly with consumer groups, so that they're reassured about what we're doing. But we have a website, costdisclosure.co.uk. Please engage with that. Send a message into that, either if you disagree with what we're saying, and secondly, if you think that you would like to help beyond what we're able to do. So that's where we are, Jonathan. It's still, where I'm afraid, sadly, rather frustrating. But Baroness Bowles very early on said to us, it's going to be a marathon, not a sprint. We knew it wasn't going to be 100 metres. We thought it might be a couple of laps of the track. But it's turning into a bit of an ultra marathon.
Well, we'll have to wait and see how, therefore, that develops. It's certainly going to take several months and possibly into next year and beyond before we get that resolved, which is disappointing. Before we move on to talk about the markets and the impact that cost disclosure and other things may have had, can I just ask you about this other issue involving the FCA, which is about fair value requirements on fund managers, which has had some knock-on effects in one or two places, particularly on the platforms, the likes of Hargreaves Lansdown, Interactive Investor and so on, where in a number of cases they seem to have prevented investors from actually dealing in some particular trusts which they claim have not met fair value requirements. I mean, Nick, I think you've been affected by this. There has been some relaxation, I think, by one or two platforms. But what is the situation as far as you understand it at the moment?
I think that AJ Bell have backed off a bit. They banned Corgent, for example, which is one of ours, which is a very interesting investment. And so it's tough on AJ Bell customers not being allowed to buy Corgent. They have backed off, partly because I think the fair value assessment, which is done by the fund management groups, hadn't been done in some cases because they were outside scope or whatever. I think Amido A4, which is one of ours, still doesn't meet the requirements and is still blocked by AJ Bell. But going back a few months, when all this spread to AJ Bell, we really feared the worst. That was probably a fairly low moment in about October or November, in that perfectly good trusts couldn't be dealt with on platforms. So I think it's now reverted mainly to Fidelity, and their platform has got a lot of restrictions, including, the investment trust that I help run. So it does seem to be focused on one platform now, but it looked dreadful about 6 months ago, where one platform takes the stance and the others follow. It did feel like a near-death moment for the investment trust movement, which has survived world wars, but maybe not the current regulatory environment.
And Ben, I don't suppose that you're particularly in favour of this move either. It's an interesting one. I mean, the FCA has a remit to do various things to protect consumers and investors, but this is a strange one, to try and stop people exercising their freedom to buy or sell shares that are listed on the public markets.
Yeah, you could probably do about 3 podcasts on this because it touches on so many issues. With the AJ Bell thing is just fascinating, because how do you assess value of an investment company where the value of the investment company is changing on a minute-by-minute basis? And the whole problem, of course, was that should you be assessing value at the NAV level when you're not paying the NAV? You're paying the share price. That's the first thing. Second thing is there's no obligation on investment companies from a regulatory point of view to produce an assessment of value. So what you were seeing was that platforms who were rightly fulfilling their obligations under the Consumer Duty. And the Consumer Duty, of course, says that you have to make sure that anything that you are distributing as a platform, you have to make sure that that thing offers fair value. Well, if the thing that you're putting on your platform hasn't got anything to say that we are fair value, that it's offering value, what do you do? So, in some cases, they were employing third parties And I think the conclusions that third parties were coming to were slightly, how should I put it, probably not how I would have assessed the value, let's put it this way, which is, for me, entirely related to the share price, of course, because that's what we invest in. So poor old investment companies just completely fell between a rock and a hard place. If it's an open-ended fund, you've got an obligation to produce an assessment of value and a fair value assessment now. But the investment companies, no. So you're either seeing investment companies voluntarily producing these documents to help out platforms with this sort of due diligence, or I think what you're actually seeing is the realization that the value in an investment company is its share price. And so the assessment of its value should be done by the buyer, just as you would with Marks and Spencer's or Next or any other listed corporate entity, none of whom are required to produce assessments of value. And in no cases where are these similar kind of consumer protections. So as Nick said, it was a bit dystopian for a while there, but we've edged towards a slightly better outcome.
It does seem another example where investment trusts are being penalised, not even deliberately in a way. It's just been a fallout from an attempt by a well-meaning regulatory initiative, of course. Consumer duty is a sensible thing. But particularly as far as investment trusts are concerned, where the share price is, if something's trading at a discount, that means it's performed probably relatively poorly if it's gone out to a wide discount. But actually, then rather than being not fair value, it becomes very good value, right? Sort of paradox in a way. So if you're only basing it on past performance, then your conclusion about fair value might be different from if you're doing it on a looking forward basis.
Yeah, well, as I say, the road to hell is paved with good intentions. And the investment trusts are different, and they do say in this world of standardisation, don't be different.
Yeah. And of course, being listed companies, they do have this whole raft of protections under company law and stock exchange regulations and so on, which don't apply to many open-ended funds. So it does seem very bizarre to be over-eager to overlay this regulatory concept on something which is not applied to other listed companies.
There's always the annual report, and they get ever longer. So you've probably got 200 pages of disclosures on your typical investment trust. So yes, don't get me started on it. It's bad enough for Ben, who spends his life trying to sort this out.
My spare time, Nick. Not my. No, don't worry. I'm looking after the funds as well. But where I do have a bit of sympathy is that sometimes investment companies market themselves to retail investors. You can see it in retail magazines, and they market themselves potentially in a certain way. And if you're marketing yourselves in a certain way to a retail customer base that is less sophisticated, I do think that there is a case to say you shouldn't just say purely caveat emptor, all the disclosures are in the reports and accounts. And I think it really is useful to extract relevant bits from the reports and accounts and disclose them in a helpful way. And that's why you've seen the AIC's, what it's currently called, I think it's a misnomer, but ongoing charge methodology, which is guidance on a best practice basis for investment company AIFMs to calculate their ongoing costs and express them as a percentage of NAV. And I think that's useful information. So I think that where you have investment companies that, particularly where they're marketed to non-professional investors, that information definitely needs to be disclosed to them, because those retail investors are being marketed these things as potential substitutes for open-ended funds. But it's really important that those disclosures are surfaced in the right way, and they should be surfaced not as product costs, i.e. deductions from investor capital. They should be surfaced as a very, very useful accounting ratio.
So let's take the example of Cordiant. So if you deem that Cordiant does not offer fair value, and yet you as a professional investor, Nick, you like it, you own it, and you think it's a good investment, I mean, they're basically saying that some unelected person knows better than you do, right?
Indeed. And also, if the platform is a supermarket, there's lots of foodstuffs in supermarkets that are unhealthy, but they don't prevent us from buying them. If you're going to be a supermarket, you should be selling everything, unless there's something particularly special. But Cordiant is not that complicated an idea. Telecom towers in Eastern Europe, etc. Data centres in New York. It's not that complex. So I think supermarkets should be open to all.
Okay, well, these are all things that obviously weigh on the way that investment trusts perform. However, I remember you saying, Nick, back in the autumn that this was one of the greatest sort of buying opportunities for investment trust investors that we've seen for a while. And indeed, it has been pretty good since the end of October, which is when I think the market finally turned. The investment trust index up around 17%, which is not bad. And of course, a lot of trusts have done better than that. I think I counted about 140 out of 300 and something or other that have done better than that. Obviously, one or two have not done so well, but not that many. So where do you think we are? I mean, are you disappointed by the kind of progress that the investment trust sector has made? The discount remains pretty stubbornly wide, average discount around 14%. What's your take on what's happened since October, and where do you think we are now?
Well, we're beginning to see more corporate activity. I think we've had a bit of a phony war. The attraction, particularly in the alternatives, is that there is a lack of demand for those vehicles because relative to the supply, there's an enormous amount of supply. But these were created to solve the problem of yield starvation for investors when deposit rates are effectively zero. Now you can get sort of 4.5%, maybe 5% on shorter dated government securities. So why own an infrastructure fund on then 6.5%? But the oversupply is what makes the discounts incredibly wide. But there's an arbitrage opportunity in that it's the lack of demand for the vehicle, not lack of demand for the assets they actually own. And at some point, if the stock market can't value something properly because of internal reasons, the real world then comes and takes those assets. And I think that day is getting ever closer.
Well, let's talk about that for a second. I mean, we have seen quite a lot of activity in the commercial property sector so far. We've had a lot of deals there, not always from outside the sector, but mergers and so on. But we haven't seen much of that happening in infrastructure at all, have we? So, Ben, I think you think the infrastructure sector still looks interesting and good value. Would that be how you'd sum it up in a climate of possible interest rates coming?
Yeah, I would sum it up like that. I just correct you on the still bit. I think the value has certainly emerged and we've become very interested in it recently. And I suppose this is the talk your own book segment of the podcast. So going to put a health warning to everybody on that a lot of our funds own these things I'm about to talk about. And I think that the reason why the infrastructure trusts are so interesting is valuation. And what I mean by valuation is, discount to NAV and the dividend stream that you can earn that is attractive relative to the share price that you're paying at the moment. But you're right, there hasn't been as much aggressive corporate activity, but that's because you've got trusts like Hickel who've been able to sell around 500 million or so, I believe it is, of assets over the past 12 months at a premium to book value so they can prove their NAV. So what they're doing is preempting, or rather doing exactly the right thing in terms of capital allocation to prevent a sort of unsolicited situation potentially where you might get a third party coming in and doing something more aggressive and, as I said, unsolicited. So I think this area is really, really attractive, and it's attractive not just because there are existing discounts, but you've got boards and managers who are responding in the right way.
Do you share that view, Nick? You do have some exposure to it. What are your thoughts on that, and which ones are you looking at?
Well, we're in the alternative space, less so on infrastructure, but there's no particular reason for that. So the four obvious ones are Aquila European, Atrato On-Site, Corgent we discussed, and the VH fund. So they're all doing very, very different things. But the interesting thing is they haven't really sorted out the wheat from the chaff yet. So a lot of these things trade on big discounts because the peer group trades on a big discount. Atrato On-Site, for example, has very little merchant exposure, i.e. exposure to rise and fall in power prices. It basically puts this equipment on roofs of factories such as Britvic, then sells the electricity to the tenant at well below grid prices, but at a fixed rate. So one of the uncertainties with power prices, particularly in the UK, have been very weak, just doesn't apply. But it still trades on a bigger discount than the peer group.
What does it need for that to change? Where is the marginal buyer going to come from?
It's a bit like private equity, that there's an oversupply situation or there is an issue that covers the entire sector. So we need to see the oversupply taken out. We're beginning to see it via buybacks, mergers, acquisitions. But until the oversupply of a vast amount of paper in the sector, you've got more sellers than buyers, and discounts will remain very wide. But that will change.
It will change, but we don't know exactly when. So it takes time for the supply to contract.
Exactly. We've had a bit of a phony war so far where people have done a bit of a buyback or whatever, but obviously it won't have that much effect given the sheer oversupply situation. But when it starts happening quickly.
It's been an interesting development recently, just going back to the commercial property sector for a moment. We've actually heard about a potential IPO, which is quite an interesting one. It's called Special Opportunities. Not a kind of name that I would choose, actually, I think, but it kind of has echoes of an interesting opportunity. We're not going to tell you what it is. But it is pretty clear what it is in this case. It is a commercial property venture, and it's led by three of the team who used to manage LXI before it got merged with London Metric. I mean, it's encouraging to see an IPO at all. I guess we should start by saying that. But did this one surprise you at all?
No, I mean, it's been quite difficult to buy property stocks. If you're trying to buy some of our special situations, such as Real Estate Investors, which specialises in Birmingham, you look at the bids and offers, everyone's trying to buy these things where they've been friendless for a long period. So definitely getting the feel that investors are calling the turn in the property market and beginning to buy in these situations. So no surprise that some professionals in the sector are trying to time this moment to introduce a turnaround fund, or recovery fund might be a better way of terming it.
So is this something you might look at, Ben? It's interesting to see, for example, that Marcus Fairmudge, who manages TR Property, successful investor in other listed property companies, he's backing this new IPO. Would that be something you would look at, or does it not meet your kind of criteria?
I definitely look at it. We're always open-minded, and when Marcus cornerstones something, it's worth paying attention because Marcus knows his property onions. Actually, you kindly put some of the stuff that we wrote in your handbook about recommendations for improvements in investment company governance and processes. And one of the things that has always irked us is the IPO process. And the thing with Special Opportunities REIT is still having to pay £1 for 98p of assets. That still really annoys me.
So just to be clear, that's because obviously there are fees attached and so on and so forth. So you don't actually get 100p of value for your pound you're investing. That's what you're saying.
Yeah, you get 98p. You have to pay the launch costs of the vehicle. Exactly. That's always annoyed me. But at least in this particular example, the fee structure for the investment advisor is more shareholder friendly than average. So it's linked to the cash return for shareholders. I wish it could be even better. I still wish that you could get 100p of assets for your 100p spent. I wish the base load could be slightly even less generous. So what I mean is what they're paying the investment advisors could be a little bit less generous, shall we say, so that they really, really, really incentivize to earn a cash return for shareholders. But we're open-minded. We'll be watching it. It's a good idea. It's a really good idea what in terms they're doing, the lot sizes of real estate that they're going after. It sounds like there's some tremendous opportunities. It's something we'll certainly be monitoring.
Here's a general question, Nick. Do you like self-managed trusts? Do you see the logic for them?
I take it on a case-by-case basis. I haven't got a preference one way or the other. So, yeah, it's more the investment proposition. Just touching on IPOs, I mean, one of the weaknesses of the closed-ended structure is that you have to raise all the money in one go. And that means that quite often you can only launch a trust in a sector that's hot. And a sector that's already hot is not normally one that you want to invest in. So just at the moment where it would be fantastic to invest when something's completely bombed out, then you have got no hope of raising a new investment trust. Although the one we're talking about at the moment is quite different because it's being backed by a lot of property professionals, but it's very difficult to get one of those away when it's the right time to be investing in the sector.
Yeah, I think that's such a good point, Nick. And perhaps segueing on is the one area, I think we both like this area, is shipping. The shipping trusts, when they IPO'd, I think they were able to do so because they were completely new to the sector. So we didn't know whether it was hot or not necessarily. And they launched because they'd identified a particular opportunity where they're able to buy really good ships at really low prices because the sector was depressed at that time. But I think that's rather the exception that proves the rule, perhaps.
Yeah, absolutely.
I wonder in that context what you made of the recent developments at Asia Dragon, because this is kind of perhaps a counter-example where you've got this very small investment trust that did an IPO with a very small amount of money, Ashoka White Oak Emerging Markets, and now they've been encouraged to make this bid for Asia Dragon. Do you think that's a way forward, perhaps, that we might get around some of your objections to the process?
Well, I think getting yourself launched is an achievement, and they've managed to do it. They've got some big backers, and it's a very well-regarded organisation. So if you can get yourself up and running, you can either maybe then attract some new cash or merge with another trust as they're trying to do at the moment. Because one of the problems they'll have is that they'll have quite big backers. I don't know what the market cap is at the moment, but it's very, very small, who can't invest the money they want to invest in that trust because they'd have to own a vast percentage of the trust to move the needle. So merging with a larger trust will hopefully resolve that problem, and those frustrated buyers will be able to get in and basically sort of offset long-term shareholders in the target trust who will probably be going the other way.
I just thought it was an interesting development. Perhaps there isn't one can generalise about. We don't know whether they're going to succeed or not, or whether somebody else will come in, but it does seem to be another blow, certainly for Aberdeen, unfortunately, having their struggles, to hang on to that one. I mentioned at the top that there are other elections going on which are quite important, and one which I think obviously is of interest to you, Nick, is the Indian election, which happened this week, and to the surprise of many at least, saw Mr. Modi lose his majority. You know, you've had an interest in the Indian market for a while, and that has been very hot. What are your thoughts about India now, and what are you thinking about doing?
We've got one holding left in large caps in India. We sold the sort of the mid and small exposure because that's been a really, really strong market and probably was getting a little bit frothy. It will make it difficult to get some difficult or controversial bits of legislation through, but I imagine that Modi will remain in charge. It probably doesn't make that much difference. I mean, the strong case for India is that it's a big beneficiary of the friction between China and the US. And a lot of the investment in plant, foreign direct inflows, etc., that used to be going into China will now go to places like Vietnam, India and Mexico. And I don't think the political situation with Modi will make any difference to that in the medium to longer term. So a bit of short-term excitement. Obviously, on the exit polls, the Indian Investment Trust went through the roof. And then a day or two later, they sunk to the floor again when Modi didn't get his majority. But, yesterday and today, they recovered much of the fall. So I suspect this is just a sort of 5-minute wonder, and the basic investment case remains unaltered.
Can I ask you then, Ben, about what you're doing at the moment? And do you subscribe to this view, which I've seen pushed by one or two brokers, that this is a good time to be looking at emerging markets generally? Obviously, the emerging markets are dominated by China and India, and Vietnam is coming up towards emerging market status. We've also seen this week some interesting announcements by Templeton Emerging Markets, the kind of oldest emerging market trust, saying they're starting to get religion about discounts and capital allocation. What are your thoughts about emerging market? Do they play a big part in your portfolio?
We do have holdings. Our main holdings, sadly for you and perhaps listeners, are in the open-ended world. But we are watching with interest the development you mentioned with Ashoka White Oak. Fantastic team. I think Nick and I, if I can speak for Nick, we're both sort of natural Davids against the Goliaths in our world. And it's nice to see what Ashoka White Oak are doing. I've got nothing personally against Asia Dragon, but if it succeeds, I think it's a fantastic precedent that's set. And there's a very particular set of circumstances that are enabling to do this, not least a very decent rating on their own trust. But emerging markets are really, really interesting at the moment because just looking at performance, so relative to developed markets, they're at relative lows. And it's difficult to be too generalistic about emerging markets because they're so heterogeneous. I mean, within emerging markets, there's entirely different economies and stock markets and opportunities. But if I'm going to try and generalize, I think that the valuation opportunities are really, really interesting. And for talented managers, the probability of making outsized returns here are very, very high indeed. We've always struggled a bit, actually, in emerging markets in the closed-ended space for really interesting opportunities, which is why we welcome what Biotech Ashoka are doing. I think, as I said to you, they're a really good disciplined team. What they've done in India is fantastic. So it's wonderful to see a new investment company in that space. And of course, the founder had a wonderful track record at Goldman Sachs doing emerging markets as well. So it's not as if it's just an extension of what was happening in India. The track record was there for another space. So really interested in emerging and watching with a lot of interest what's happening with Dragon.
Yeah, I mean, it is one of the few areas where active management clearly can play a very strong role. I think that's been proved by the Ashoka team. So, Nick, I know you're back to India and you're back to Vietnam through some specialist vehicles, but you've also had an exposure to Georgia, which has been an interesting one. What's your take on what's happening there?
Well, we've learned a lot about Georgia in recent weeks and months. Georgia has made its money by being the conduit between the East and West in that area, and a lot of business comes through Georgia into that part of the world from the West. So the Georgian government needs to keep a balance, a foot in both camps. But that's very difficult where the masses or the main population want to be much closer to Europe. Maybe 80% of the population wants to get closer to Europe. But in this period of geopolitical sort of plates parting, it's getting much more difficult for countries to keep one foot in both camps. Vietnam is another example, perhaps, where they're going to have to be quite flexible. So, a new law has been put in place which makes it much more difficult for Georgia to move into Europe. Although, from our point of view, I felt that joining Europe was probably not going to happen because it makes its natural role more difficult. So we'll see what happens. Politics in Georgia has been rumbustious for a long period of time, but it has reached newer limits. So we've sold some shares into the buyback. I think a lot of the noise, once the elections are out of the way, will quieten down. But obviously the risks have increased, and therefore the conviction towards the view is not as great as it was. So it's a much smaller position than it was. But we'll keep watching. So long as there are elections in October, hopefully things will sort itself out. But if there aren't elections in October, then we may have a much more serious problem.
Yeah. I mean, this is the year of elections, as we know, all over the world, and some have gone in a favourable direction, perhaps for investors, others less so, and this might be one of them. But it's still very cheap, obviously, but it's cheap for a reason now.
Well, I mean, it was already cheap because marketing a single country fund in Eastern Europe with a long board with Russia and the fact that we went to war with Russia in 2008 was enough to choke off demand for this product. And therefore, part of the thesis is that they will work out at some point that being a UK investment trust is just too much hard work. And another structure is the way to go forward, which will eliminate the discount. And the discount has been trading before the recent political troubles at around a 60 discount. So counterintuitively, the moment where it's continuing as a UK investment trust is just too much hard work has obviously been brought closer. So counterintuitively, there may be some good news in this for shareholders of Georgia Capital.
Let's talk then next about private equity and growth capital in particular. This is an area where we've obviously seen a lot of cultural change in the way that these trusts are managed. They've always traded on big discounts, or many of them have traded on big discounts. Exceptions, obviously, to the rule. But again, here the boards more generally do seem to be getting, I keep calling it getting religion, but you know what I mean by that. Articulating clear capital allocation policies and making an attempt to drive in the discount. Does that make that an attractive opportunity for either of you to look at afresh? Obviously, you have a small holding in that, Nick, but what's your thought about private equity? Ben, I'll start with you.
So we've always liked private equity. The private equity that you can access via the listed closed-ended investment company sector is actually fantastic. It's actually very hard knowing which ones to own because the quality is generally very, very high, I think. So we've always liked it. They've always been a meaningful part of our portfolios, not least because you can buy £100 of assets for 60p in the pound an awful lot of the time. But one thing I would say is that you just mentioned that the sector's sort of getting religion. But I do feel a bit sorry for a holding that we've liked and is one of our biggest holdings, Oakley Capital Investments. They're well ahead of the curve. I mean, they had a bad reputation way back along, many years back when they issued some shares into discount. I mean, but that is long history, and they've worked so tirelessly to rid themselves of that. And their capital allocation policy is second to none. And they don't just buy back shares, they cancel them. People forget this sort of stuff, is that sometimes when you buy back shares, they can sit in Treasury and they can sort of lurk in the Treasury and you think, might they reissue these at a discount again? But they cancel them, which is a really big statement. And it's one of the things we look for as it happens. So first thing I'd like to say that there's been a champion in terms of good capital allocation and corporate governance out there long before the wonderful Mr. Singer did his thing at Pantheon. But I think what he's done there is fantastic because what he's done there is really be vocal. And he's laid down a marker to say, this is how we need to behave. We have to look after shareholders and allocate capital properly. And even within the constraints of what we do, which is they don't have tremendously liquid portfolios, but realizations are coming in, and using those liquid resources, you can do things to help enhance returns. And it's not just about doing so to narrow the discount. It's about showing the market that your capital allocation policies are in favour of shareholders, which should help to increase demand for shares, with the impact being that the discount narrows as a result. Nick, I don't know whether you agree with that.
Yeah, we own Oakley as well and own them because they're just very good at what they do. We also got MB Private Equity, which are the two holdings we have in that area. I think the other point to make and why they trade on such wide discounts is back to the cost issue, because these are expensive products and they get some very strange results, particularly the fund of funds, where in some cases we've seen OCFs of 7%. Which makes them uninvestable for large tracts of the market. Because if you're working for one of the mega wealth management chains and you wanted to put one of the more expensive ones of these trusts into your model, if it's 700 basis points is the OCF figure, then putting a 2% holding into your product adds 14 basis points to what you have to disclose. In a world where it's more than 99, people won't even look at you. It just doesn't work. And that's leaving a big overhang in the market on all the trusts in this sector, and explains, to my mind, why discounts remain wide. Once those investors are off the register, there's some scope for the discounts to narrow.
Yeah, totally agree, Nick. It's a really good point because the wealth management community started being hit by these frustrating cost disclosure rules back in 2018, which was when MiFID came in. And under MiFID, they had to start disclosing these expenses as if they were ongoing charges. And so if you speak to investor relations at private equity firms, they've been saying for years and years how difficult it is to attract investment from the wealth managers, or DFMs, whatever you want to call them, for exactly the reason Nick's just said. So there's been a real boiling frog going on with discounts in that sector, and they found it very difficult to attract capital from that constituency of investors. And now they're finding it hard to attract capital from all investors in this country, practically, for those reasons. Yeah. It's so frustrating because, as I said, those expenses, where there is a fund of funds and there's an extra layer of fees from investing in other funds, well, then you can look through, those are happening and they'll be discounted into the share price. So Nick refers to them as expensive. I sort of prefer the word high cost because their post-fee returns at the NAV level are fantastic. So it's there's that one point. And that's, of course, those high costs are only impacting the NAV rather than the share price. That back to that argument. So still wonderful opportunities in the sector and very pleased with what Singer has done in terms of laying down the gauntlet. I think it's caused standards to be raised across the sector.
Right, but it's still some way to go before we can actually resolve the sort of perma discount issue. I mean, there are some exceptions, of course, which specialist private equity trusts that don't trade at a discount. So the likes of Literacy Capital and others. HG Capital obviously being a special case as well. not to mention the phenomenon that is 3i, which does seem extraordinary. Let's move on. A couple more questions I want to throw at you before we wrap up. So I'm going to start with you, Nick, if I may. And I wanted to ask you about Biotech. So Biotech is a sort of dog that hasn't barked, as far as I can see. I mean, it's been, in the doghouse for quite a long time now, and still waiting for some sort of catalyst to really put some motor under what are still potentially very good investments. You did own a couple of trusts in that sector. Are you still hoping for the good times to roll?
Yes, I think so. I think the biotech sector has been harshly treated because profits are a long way in the future. And the period where growth capital had until recently been struggling because they were deemed not profitable and there were fears that they wouldn't be able to raise more capital to develop their businesses. Biotech is quite different in that profits are a long way down the line in the smaller and medium-sized stocks. But that's the basic business model. You raise the money up front, you spend it on the research, getting your product to market, and off you go. I think it's got dragged into what we might call long-duration assets, where profits are a long way down the line, and that's made the sector fairly friendless. At a time when a lot of the big pharma companies and their main products are running out of patent, and they're going to need new products to sell. And basically, product development takes place in the biotech sector, and then if it's successful, it's then sold on to the biotech company. So what you would expect in a period like this is a lot of acquisitions of small and medium-sized biotechs by big pharma at massive premiums to share prices, which we are seeing. So we were obviously attracted to the unloved and overlooked, and biotech has been friendless for a while, and as I said, harshly. So we've had international biotech, and we've had biotech investments for a while. Recently, we introduced RTW to the portfolio, which is a relatively new name, but it bought out a rival trust called Arix for shares, and that's left an almighty overhang in the market, and therefore RTW trades at a very significant discount, even though it's a perfectly good company and will benefit from all the trends in the biotech market. So, yeah, very much still heavily exposed to biotech and remain optimistic.
Do you have a view on that, Ben, or is this not part of your asset allocation process?
No, looked at RTW and can't disagree with anything Nick said there. Just competition for capital. You can't own anything, and we are spoilt for choice in terms of opportunities in this sector at the moment.
Well, I think it's an important point that there are so many opportunities around, and somebody was challenging me on HarbourVest, and I couldn't argue that you were going to lose money on it. It was going to be very profitable if you bought it, but it's just making decent returns just isn't enough to get in the portfolio at the moment because there are so many trusts that are completely bombed out for non-fundamental reasons. And it's why MIGO is now geared, which is unusual, but there's just so many more buying opportunities than selling, and we keep buying. So, we've drawn down some debt and to take advantage. Because, there have been times in recent weeks and months where discounts are pretty well at an all-time high. I mean, I've been doing this since the mid-'80s. And you'd get quite excited once the discount went over 10. I got very excited when the average discount in MIGO went over 20. A recent presentation, going back a month or two, it got to 35.7. So I've been permanently saying this is incredibly cheap and you must get in. And it just gets cheaper. But I think October, November time was probably the nadir when I think you're right in the middle of the AJ Bell thing when a perfectly sensible platform is suddenly doing what seems to be strange things. And you're thinking this is going to inflict real damage to the sector because knowledgeable investors are on that platform.
To wrap this up then, you've sort of implied your prognosis of where we are and where we might be going. But I think I've heard you say that the election of a Labour government, which seems imminent, is not necessarily a cause for worry to the markets. That maybe we'll get some progress on cost disclosure. But what we really need is some of the supply to continue being constrained or reduced and demand to come back. On that point, do you think that we will ever see pension funds coming back into the investment trust sector, for example? Is that a source of demand, maybe directed by government to do so? Or what? You're obviously sounding optimistic, but then both of you, as you said, have a vested interest in being optimistic. But what are your real thoughts about the sector and where it's going from here?
Ben might be more knowledgeable in this area than I am, but it's difficult to see the pension funds, etc., coming back into this sector in the short term. But what I would say is that the investment trust sector continuously evolves to take advantage of the environment that it sits in, and it just keeps changing. And if you go back to what it was 20 years ago, it was very different. And you go back 50 years ago, and the sector was doing something totally different again. So we will see evolution. We won't necessarily be the trust that exists today, but there will be closed-ended products. Liquidity is a challenge, and investment trusts protect portfolio managers from inflows and outflows, which is incredibly important and a big generator of performance. So, yes, not in the short term. I think the short term is all about corporate activity, tidying up the excesses of the latest new issue boom, which will be very profitable for investors who want to get involved. But the long-term growth, that's 2-3 years down the line, and maybe vehicles that look slightly different from the ones we see today.
A couple of things I want to say is just on the pension funds. Yep, Nick's right. I don't think that pension funds are going to suddenly come back to the sector. The issue there is listed closed-ended investment companies should be absolutely perfect vehicles for smaller pension funds who can't invest directly in less liquid assets. And the fact that they have been put off for two reasons. One is cost disclosures, and there's a charge cap. So this is what really sends me doolally sometimes. The charge cap's quite low, and the recurring operating expenses expressed as a percentage of NAV, which is being forced to be called ongoing charges, for less liquid asset classes is very high. So they can't do it. And now, because of the discounts that have emerged, because of the people selling for these reasons, I think pension funds are looking at the volatility of these things and saying, well, they don't really look like the performance of the underlying assets. So, hang on a minute. So it's going to take a long term for that constituency of investors to return. But one day I'm pretty sure they will. The other thing I'd say is that you said that we've got a vested interest in being positive. Now, I'm going to just push back gently on you there, Jonathan, on two things. One is Nick's been doing this for 40 years. And when someone like Nick says the opportunities are amazing, you listen. Second thing is that I don't have to buy investment companies. I run a suite of fund of funds that does both investment companies and open-ended funds. I don't have to do this. I could go off and just do open-ended funds if I like, or ETFs or anything. But I genuinely believe that the opportunity set right now is fantastic. So, we don't own RTW because there's so many other things to look at. And we haven't even mentioned UK equities. Nick loves microcaps as we do. Wonderful investment companies that take full advantage of the structure, that are very actively managed and can find the beautiful valuation anomalies that exist in UK equities. UK equities as a whole are really, really cheap, but it's at the micro and small end that they're especially cheap. And you don't have to just look at the investment companies that are on a discount. Even the ones that aren't are still wonderfully managed and producing fantastic results, the likes of Adician, I'm thinking of there, for example. But you can look at RMMC on a decent discount. So the note of optimism that we're both sounding, I don't think is driven by self-interest and a vested interest. It's because it's there, and we'll make money via a, inverted commas, bad way, which is the sector shrinking and corporate action. We'll still make money, but hopefully over the medium term, we'll make money for the good reasons, which is capital eventually returning to the sector and the discounts narrowing naturally. And who knows, one day, hopefully while we're both still employed, we'll be back to Premier and these things will be growing again.
Well, of course, I have to say that I'm not without a vested interest myself in this particular sector either. But that's very good to hear. I mean, I think you make some very good points there, though I think the important thing is you need to look at it with crystal clear eye and without any kind of obfuscation or issues of self-interest. Of course, we look at the facts as they are. And the facts as they are say, to me anyway, that there's a lot of opportunities out there. And I think you both agree with that. So that was Ben Conway, Head of Fund Management at Hawksmoor Fund Management, and Nick Greenwood, the manager of MIGO Opportunities, ticker MIGO, talking to me this week.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.